the 50 basis point rate cut, the market has been all over the place. It had a sharp recovery. After that, there's been a bit of a sell-off again, not quite to the low point of the day, but the recovery was sold into a bit. So it'll be interesting to see if the morning's low is held, because that's going to be important. Let's get some reactions as well very quickly. Ananth, Narayan is still with us. Ananth, this came out of nowhere, really, the 50 basis point rate cut and further accommodative stance in the policy. We've already seen the yields go to 763 now. What's the trajectory here?
Anuj, this is early Diwali, Christmas and Happy New Year for the bond markets. Frankly, we couldn't have asked for more. We've got a surprise 50 basis points rate cut. We've got a guidance which is far more dovish than the market expected. The 4.8% glide path to inflation 2017 is a huge positive. Plus, there's been clarity on the FPI regime for government bond limits, which clearly indicates that a substantial amount of limits will be opened up between now and 2018 March, which eases the supply-demand pressure on government bonds. Effectively, it's already been 15 to 20 basis points of rally in the bond markets, depending on which part of the curve you look at. I think the trend continues. I think 10-year bonds yields will head towards 7.5 and south of that, especially once the limits start to open up on the FPI side. So all in all, extremely good news for the bond markets. Rupee as well, will take heart from the fact that the FPI limits will be opened up and there is a glide path towards that. And you might see supplies sort of coming in anticipation of that.
Okay, well, in fact, we have the yield, which is now sub 7.6%. So it's been a good 20 basis point softening, which is or close to that, which has taken place for the bond markets. Mr. Kannan, I wanted to come to you with regards to something that was announced on affordable housing. Currently, the minimum risk weight applicable on individual loans is 50%, with a view to improve the affordability of low-cost housing. The RBI has basically proposed to reduce the risk weights applicable to lower value but well collateralized debt in individual housing loans. Can you explain to us what this means with regards to State Bank of India as well as the housing sector?
In fact, banks like SBI are actually going to be substantially benefited because we have a very large proportion of our funding to the low-cost housing. And depending on the quantum, I think we should be in a position to give probably a differential pricing to them. And this will be a big advantage to banks like us where the risk weightage comes down.
Okay.
Overall, it's a big positive for us. And of course, the main thing, the 50 basis point cut is a big bonanza. As I would say, the Diwali has come before the Dussehra for the first time, thanks to Mr. Rajan. And I think we will look forward to relatively benign interest rates in the next 6 months.
Okay, well, let's address markets because there's quite a bit of volatility now. It looked like the market put a bit of a floor. I mean, at least for now, it looks like that is still the case because the morning low is still held. The market had a big rally, and now we're seeing a bit of a sell-off again. Nirmal Jain now joins in, chairman of IIFL. Nirmal, hi, good afternoon. So,
hi.
What's your call? We saw sharp intraday recovery, but that's getting sold again. Do you think we are in a market where it does not matter where, what RBI does, or could this be a bit of a game changer for our market?
I mean, if I had to choose between the two alternatives, I would say this could be a game changer. Today, markets, we should see in the context of global markets because Asian markets and global markets have been very weak. So, but for this pleasant surprise or a very decisive cut in the rate, I think markets would have been, and as you know, that before the policy announcement, markets were significantly lower. So markets will continue to be guided by global factors, but within that, if you take a medium to long-term view, then I think India has a great opportunity to turn around. Now, RBI has done its bit, because the credit growth has been slow, the commodity prices have been low, so the inflation outlook also now is fairly contained. So in that, I think he has taken the rational decision to do the rate cut by 50 basis point, and maybe a 25 basis point probably would not have been good enough for two things. For the market is one, but more importantly, even for transmission by banks, because they are still reeling under NPA and cost issues. Now they have significant leeway to make sure that some transmission takes place. And I think this could be a turnaround. I mean, now the ball is in government's court. If they continue with reform, they continue with fiscal discipline, and they continue with making things easier to do business, then India can stand out in this world.
Okay, Nirmal, just to extend that point.
Opportunity to stand out.
Okay, so just to extend that point, by saying that this could be a game changer, are you saying that the Indian market may well put a floor at the previous lows, and be ready to move on from here and are going to outperform the rest of the emerging markets, regardless of which way the emerging markets move?
So I would agree with that, but with a time perspective of at least 18 months to 2 years. Because what happens in 2 to 3 months time frame or 6 months, global factors and the events particularly can weigh heavily on emerging market flows. And you should understand how the markets are moving today, because a lot of incremental money in last 5 years has come from FIs. In fact, domestic money has started coming in last 1 year. And when there are funds, there are emerging market funds and there are redemptions. And then, like what we saw a few months back when China was in a bad shape and they had sort of banned the selling, some of the funds were forced to sell even stocks from Indian, in the same fund, if they had India stock there to sell it. So I think we'll be affected by global factors. But fundamentally, there'll be a short-term impact. If you look at medium to long term, then markets should give good returns from here. So to your question, whether this is the floor, it's very difficult to say. If there's some volatility or some event which is negative for emerging market globally, you can see markets giving away a few from here also. But I think relative to other emerging markets, Indian markets should continue to do better.
Okay, well, specific stock weakness continues. So something like a Bosch has lost around 2% in the past 1 hour itself, and commodity stocks still reeling under pressure. So Tata Steel now at the low point of the day, down around 4%. We have Lata joining in from the RBI as well. Lata, you sat through the entire policy. Your takeaways?
Well, I thought there were two takeaways. One, that the forecast of 4.8% inflation in the fourth quarter of January 2017 indicates that the Reserve Bank is fairly confident that inflationary pressures have been controlled. They seem to be particularly impressed that despite a poor monsoon, food inflation has not gone up, except in pockets like pulses. So they seem to be of the impression that there is some conquest of inflation that has been achieved. Coming from a very conservative Reserve Bank, which is an inflation-fighting Reserve Bank, that is saying a lot. But it also says a lot about its very poor opinion of global growth in 2016. And chances are that is why the stock markets are behaving the way they are. It's a very negative view on growth. Just as you read the FOMC not hiking as a comment that the world is so debilitated in its growth quality. I think that quality, that comment on global growth in 2016 certainly seeps through, and this is coming from a governor who definitely knows to assess global situations better than many other peers. So that is the question really first to Nirmal Jain. Nirmal, why have the markets reacted so negatively? It's quite positive if you look at the bank P&L. They're going to be able to make better margins. They're going to make a huge amount of return profit because of the fall in bond yields and the rise in bond prices. In spite of it, the Bankex is negative. The stock markets are in the red. Why? What is irking y'all?
No, I was just talking a little while ago that we should see this in the context of global markets, because Asian markets are significantly down today. And as I was saying that, many FIIs have emerging funds which are common funds, and when you see the outflow of money, then all the markets will get impacted. Of course, relative to other markets, we are doing far better. But for this rate cut, probably you would have seen markets going further significantly lower. And if you notice that before the announcement, the markets had begun significantly weaker. So I think markets now will look forward to something from the government, the significant worry has been that the policy, the reforms are not taking place at a pace that they expected. So I would say my ball is in government's court, but give some time for market to digest this. Give some time for emerging markets in the global environment to settle down. Because the markets will be, relative to other markets, we are performing better, and that is thanks to rate cut.
Okay. Well, I believe Andhra Bank has cut its base rate by 25 basis. I will consider that a serious disappointment. 125 basis points have come from the Reserve Bank, and assuming that Andhra Bank cut 25 basis like all the other banks, this is still only 50 that is transmitted. That's bad, I would think. I'll come back to Mr. Kannan on that in a second. But first to you, Ananth, I think this is all-round Diwali for your markets. I accuse the governor of being a Santa Claus, and he noticed that. when he spoke. But isn't he being a Santa Claus? FPI investments have increased in the first 6 months itself. You're going to get, I think, what, 20,000 crores more or 25,000 crores more in the form of FPI investments. Plus you have this rate cut and an inflation target of 4.8. I mean, good all over if you were invested in bonds, isn't it?
No, absolutely, Lata. In fact, just before you joined in, I exactly made those points that you made. I reckon this is Diwali, Christmas and New Year all put together for the bond markets, frankly, and we couldn't have asked for more on every single count. Particularly, besides the 50 basis points bonanza, I think the glide path on the FPI opening up of limits is very welcome. Currently, foreign ownership of government bonds is 3.6%, saying that it will become 5% by March 2018. Plus, adding state government bonds as well into that mass is a very, very strong positive. It indicates, one of the issues the bond markets was grappling with was the question of supply and demand, and that gets mitigated to a large extent. To that extent, I see bond yields going southwards. 10-year bond should hit 7.5% and maybe even lower. 5-year bond, likewise, which are still at about 7.75, should head towards the 7.5% mark. So all in all, very, very good news for the bond markets, and that should help the transmission debate to a large extent.
Yep, actually starting March, on the day when the governor cut, if we had taken all our money from equities and put it into bonds, we would be much richer. Nifty has gone down from 9,000 to 7,700 and bond prices have risen and show promise of rising even further. And now to you, Mr. Kannan. This is really parsimonious of you bankers. I mean, 125 basis has come from the Reserve Bank. First of all, how much does that give you in terms of the investment book looking better? As well, how much can your margins improve?
See, margins will certainly improve mainly because of the higher profits we are likely to get from the bonanza in the bond market. Having said that, a portion of it will certainly be passed on to the consumers. And whatever Governor Raja mentioned about the cut in the deposit rates last year, slowly the effect is trickling down. And we have already passed on 30 basis points, and I'm sure we will be in a position to pass on some more with this cut, because we will get some benefit from the trickle-down effect of the new deposit being repriced at the lower levels. And going forward, I'm sure you will certainly be happy to get some cuts, but exact timings and the quantum we'll decide after the ALCO meets.
What is your cost of money now? What is your one-year deposit standing at 8 now?
No, it's much below 8%, and cost of deposit around 6.73. So we do have other costs, and I think going forward, if the NPA front also improves, I think there is a very strong case for passing on. Exact quantum we will decide when we look at our figures.
You make some money because your bond investments will look good, and I think SBI has 28% in government bonds. So mark-to-market gains will come your way, which perhaps you can use to provide for your NPLs. As well, a part of that money will have to be taken off because the HTM amount has been brought down to 21.5. Net, can you give us an idea of how much you make by way of MTM gains?
I'm sorry, I don't have the exact figures, but we were holding around 27% by way of SLR. So 22% is the one which was put under the HTM. The remaining 4 to 5% was under the F category. So the entire bond book would go in for a profit. But the amount would be substantial. But the HTM portion we cannot have a mark to market, and therefore we don't take the benefit unless we transfer it. And we may not straight away take it. Maybe we'll take from the AFS book and then see how much we can transmit.
Okay. You also have this advantage that the risk weight on low value home loans is going to be brought down from the current 50%. So will we get to hear some selective lowering of lending rates for low value home loans?
I think we can examine this, but frankly speaking, the demand is such that we can probably price the entire loans at the same level. But if the weightage is substantially lower, I think there's the case for a slightly much better rate for the affordable housing. That is the thought we'll be probably examining today or in a couple of days and see how much we can pass on for the affordable housing.
Okay. All right. Let me get to the Economist now. Sonal, I can imagine that many of you are going to be disappointed. Just about a few days back, or 2 weeks back, the governor was saying that if you took off the base effect, inflation is running at 5.5%, and now a 50 basis cut. Be that as it may, that is the given you have to work with. What are you? How are you assessing this 4.8% inflation for 18 months on that the RBI is so confident of? And therefore, what will you pencil in by way of monetary action in 2016?
Right. I think, Lata, actually, it's a bit surprising that they have not lowered their Jan 16 projection a bit more. It's come down by only 20 basis points, despite the fact that food prices have not picked up and you have, positive effects from lower oil prices. So, we would have thought that the inflation projection also would have been lowered a bit more. If you strip out of all these volatile components, the underlying inflation has been slightly above 5% for some time now, and therefore 4.8 is closer to 5. So essentially what the Reserve Bank is saying is that in the last 2 years we've seen significant disinflation from 9-10% to around 5%, and in the next 12-18 months the pace of disinflation will still be there, but the pace is going to be much more gradual, essentially. So it's not that much of a surprise, honestly. I think the key reason in our view for the front-loaded rate action has been the lags with which policy is getting transmitted by the banking system. And if after 9 months of 75 basis point cut, only 35 basis point have come in, and if the Reserve Bank sees more room, which it says it does because of the weaker global environment and its implications for commodity prices, then yes, it does make sense for them to front load rather than deliver it, let's say, in 25 basis point across different policies. So I think the key here is the front-loaded rate action that they have done. And going forward, therefore, the focus is going to be a lot more on the transmission of the cuts that has already been delivered. Now that could be either via the move towards the marginal cost of funding or through better recapitalization of the public sector banks, but I think the focus will be a lot more on transmission of the cuts already delivered. That's one. And second, there are also lags in transmission from the policy cuts to the broader economy. So I think to your question on what is the path going forward, our view is that they've front-loaded and they've used up the space that was available. And now they wait to see the effect that this has on the broader economy and wait to basically give banks more time to pass it on.
So nothing for the next 6 months, you would say, or nothing for the next 9 months?
Yeah, I mean, after today's surprise, not expecting anything in terms of rate action.
Okay, Sajjid, your expectations?
Lata, I think what struck me in the governor's press conference was, I think, and it doesn't come through in the statement so much, is just the concern on the global economy. I think ultimately the straw that broke the camel's back towards a 50 basis point cut seems to be two factors. One is there is a greater worry about global growth and simultaneously greater conviction that on the back of lower global growth, global commodity prices will remain benign. And second, I think it's a little more confidence now compared to 3 months ago or 6 months ago on food management. That we've been through 2 bad monsoons and yet you haven't seen that systemic food price increase. So I think those are the 2 factors that ultimately gives the RBI more confidence that perhaps swung this. Again, I agree with Sonal that the bar for future rate cuts goes up because you are disinflating from 6 to 5. I think your question is very valid that, we've got these large disinflationary forces, and yet we expect, even though growth goes up by 60, 70 basis points next year, inflation continues to slide down to 5% when you don't have the year-on-year disinflation from oil. I think that's going to be a significant challenge still. I don't think we're out of the woods as yet, and that makes the bar for any more easing much higher, but never say never. In June we said that was it. Now we're saying this is it. I think there's so much volatility in global commodity prices, global growth. I think what you're seeing today is a central bank that wants to be nimble. If in fact you see 4-handle prints through most of next year and you're below 5%, more easing could well open up. So I think they will be very data dependent, and given all the fluctuations, too hard to definitively say that there will be no more easing. I just think for the next 3-6 months, the bar is much, much higher.
Yeah, actually, the report, monetary policy report says that they expect the average inflation for FY17 to be 5.5%, but the fourth quarter of FY17 to be 4.8%. So it looks like it will be 5.5 to 6 in the first half of FY17, possibly base effect. We are standing at 3.76. For whatever reason, they're expecting inflation to remain at 5.5%, for the first half. If that is the case, maybe there will not be rate cuts, but it's really too difficult to tell. We mustn't call this a hawkish Reserve Bank in a hurry. Do we have Taimur also with us? Okay, all right. Ananth, how will you see the 10-year bond now? At the moment standing at 7.6, if I'm not mistaken. I don't have the rate here. But when do you see it touching 7.5?
It's currently, I think, about 7.58 or so. I think it's a matter of time before 7.5 happens. The immediate trigger could be as we run up to 12th of October, which is when the first set of FPI limits open up. It's a small number of $2 billion, but I think it will provide a lot of welcome relief for the market. Plus, of course, there is a line of sight on more, opening up of FPI limits, which is good news. Just one to wade into this argument of transmission in defense of banks, and particularly public sector banks. I think one thing we have to keep in mind is that it's not as if the net interest margins of banks have been increasing over the period that we've seen the 75 basis points rate cut earlier from the RBI. And I think what the governor indicates today is that it's a very nuanced argument. The whole question of transmission depends on a lot of things like small savings rates from the government, things like resolution of the NPA problem, liquidity, a question which you asked, Lata, of the governor himself, and things like, the statutory costs of LCR, etc. I think it requires all sorts of resolutions to come through for transmission to come through, but I think work is in progress to resolve that question.
Okay. Well, any other key takeaways from the policy, Sonal?
Not really. I think broadly, clearly, again, a big surprise. I think, one of the things that the RBI mentioned is that they want to use the available room front-loaded so as to kickstart corporate investment. And I'm not so sure that will really happen because of a rate cut, because, the manufacturing sector has excess capacity and the infra players have excess debt. So the macro environment that we are in, whether it's the domestic balance sheet issues or the global excess capacity issues, not really sure whether corporate investments will be able to really pick up. Of course, it's going to provide some, saving in terms of interest costs coming down marginally. But, I would reckon that the consumption side is really what gets a bigger kicker from what the Reserve Bank has delivered so far. And therefore, we still need to get back to policy measures, particularly from the government in order to kickstart the investment cycle. So I think the balance on consumption and investment, which we were fighting 2 years back, and now we do have a broad macro stability thanks also to what's happening to global commodity prices. We've used up the room. We're trying to kickstart the growth cycle. I think a lot of this will be led primarily by consumption, but we just need to make sure that investments, particularly by the government, also picks up and we don't end up again in sort of a consumption-driven growth recovery again.
Yeah, I think the RBI did sound extremely despondent on investment growth, because I think they must have said 5 times that there is output gap and that there is underutilization of capacity. And through the text as well, greenfield is not even to be thought of because there is still a lot of underutilized capacity that clearly seeped in. So investment at the moment is not what they're looking at, probably sometime in the distant future. But there is a lot even for the markets, and I wanted both Nirmal and Ananth to speak about that. For those groups and companies with large exposures, the government, the RBI is looking for these large corporates to borrow even their working capital from the market. So that looks like a shot in the arm for the capital markets, especially the bond markets, and along with the credit enhancement, it looks like the bond markets are in for a little bit of rise in volume. As well, I think the currency futures market is getting a very big fillip with individual exposures in the OTC market. I'll just read that out. To provide more flexibility to market participants in managing their currency risk in the OTC market and for making hedging easier, it has been decided to increase the limit for resident entities for hedging their forex exposure in the OTC market from $250,000 to $1 million without any underlying documents. Ananth, so the FX market gets a huge shot in the arm. As well, even the currency futures market, standalone PDs are going to be allowed to deal in currency futures. So first to you, Ananth, you see bond markets separately and the FX markets getting a fillip in terms of volumes?
Absolutely, Lata. I think these are welcome reform measures. We've always noted that there is a dichotomy between the rules in the OTC market and the futures market, where OTC market is heavily regulated, requires underlying, whereas the futures market is reasonably open and allows everybody to participate without underlying. That gap is being bridged by the steps being taken today, and the liquidity in the futures market is further being enhanced thanks to the allowing of PDs to participate in that market. So all welcome measures and clearly indicative of the confidence that the RBI has in opening up markets and allowing people to actually hedge their exposures and trade in markets. On the bond markets, likewise, I think opening up of state government bond limits for FPI, along with the enhancement of FPI limits overall, bodes extremely well for the overall bond markets. If we do get this part about transmission right, we could see a lot of enhancement in the overall bond markets as well. Not to take away the fact that there are, the issues of stressed corporate balance sheets and banking balance sheets, which need far more than just rate cuts to repair. But nevertheless, I think the rate cut and the treasury gains this provides will provide a lot of relief to an already stressed system.
Okay. That's positive words coming from you. Mr. KK Mistry has also joined us. Mr. Mistry, good afternoon. Thanks so much for joining. This low-value home loans risk weights getting reduced. Of course, this is now for the banks, but NHB normally follows suit. So are we going to see a precipitous fall in your home loan rates? You're getting a rate cut. As well, you are getting low-value home loans to be weighted less with capital.
Lata, it depends on what the definition of affordable housing is. So there are several definitions which are there in the market. There is a definition which says affordable housing is loans less than 25 lakhs. If you look at the definition of affordable housing that came in a year ago, there they defined affordable housing as non-metro cities, loans of 40 lakhs and property value of 50 lakhs. And metro cities, they defined affordable housing as loans of 50 lakhs and property value of 65 lakhs. Now, if we go by the second definition, which is the more recent one, which came in July last year, then it roughly covers about 60% of our loan book. Our average loan size is 23.4 lakhs for new loans we given in the current year, and therefore my sense is that if, depending on the definition, reasonably substantial portion of our book will get covered by this definition. Obviously, if there is less capital that is deployed in doing a loan, then the financial cost, the ultimate cost of doing a loan also comes down. So if we get the benefit of a lower interest rate, and if we were to also get a benefit of a lower risk weight on affordable housing, then naturally those costs will be, or those benefit in costs will be passed on to customers.
Do I hear 50 basis?
I can't comment on that, Lata. It's too early to make comments about whether it's 25.
It's substantial. Come on, Mr. Mistry, you're making money hand over fist.
My spreads are stable, Lata.
Lower cost of money.
Yeah, but my spreads have been 2.30 to 2.32% now for a long while. So it's not that spreads have been going higher. Whenever spreads go higher,
but they will
we
fall,
always
isn't
pass
it?
the benefit. So as spreads go higher...
No, but your cost of money will fall.
Cost of money hopefully will come down. We have to see the impact in the market. We don't borrow money from RBI. We borrow money in the market. So we have to now reduce our deposit
From the market.
rate.
Yeah, but that is all the more reason. I mean, if you had borrowed money from banks, you wouldn't have been a beneficiary. Precisely because you're borrowing from the market, your cost of money would have fallen in the last 18 months by 300 basis points.
No, it's not fallen by 300 basis points. Certainly not by 300 basis points. It has fallen a bit, but it's not fallen by 300 basis points.
Okay, no, but you think there is space opens up for...
I think there is space open to look at lending rates or look at the reduction in rates, but quantum of reduction in rates is not something I can comment on. We have to see how the rates actually, our actual cost of funding comes down and what the affordable housing is.
When is your ALCO meet? Should we hear something before the day is out?
No, I don't think you can hear that fast because we won't know that fast how rates are changing. It takes a couple of days for markets to stabilize.
Okay. Mr. Kannan, you think you all can be in a position to announce a separate loan rate for homes and a separate base rate cut?
I think the latter one is quite possible, but separate home loans, we will have to look at our portfolio, and because we cannot obviously have a differential and differential base rate cut. Probably we'll have a differential in the pricing, the markup over the base rate for the lower affordable cost. But the full particulars of the instructions have to come out, and once we receive that, we will take a call, because I think as of now they have not mentioned the full details. I think once I get the full details, we will work out the amount, the basis point which you can pass on, if possible.
Okay. If possible, Mr. Kannan, you are more conservative than the Reserve Bank Governor. But actually the markets are now taking in more of the good news, it appears. I saw a bit of green on the Bankex, and the Sensex now is 17 points higher. Ekta, take it away.
Nifty is currently flattened out. We have the Nifty, which is just about holding 10 points away from the day high of around 7,800. And the Bank Nifty is the one which is really reversed. It was seeing quite a choppy